So today we're doing a lender Q&A session with Mr. Marc Rabkin. He's with Rodeo Lending. If you guys haven't been on our lender Q&A calls before, this is a weekly call that we do with the lenders that are in our lender bucket list. If you guys become part of the community, you're going to get access to that lender bucket list, and you're going to be getting a recording after this video, access to Marc. Obviously, Marc's been with the company for a long time, and you're going to get a breakdown of that Excel worksheet that we're going to go through later today. So, Marc, I appreciate you being on today, brother.
Yeah, no worries. I'm going to send you, John, so you could send it out to your group. I'll send you a synopsis of what I'm going to go over. It will be like our focus list, property types,
Cool.
locations, bridge loan types, leverage and pricing, and a link to our funding page so people could see the past deals that we've funded.
That's
That
a good
gives you a
idea.
great idea of what we like and what we're looking for.
If you want to share your screen today, you can feel free to present whatever you want, including the website, how to drop a deal in your bucket. I love to, walk people through. I want people to get as comfortable as possible dropping loans into Rodeo's bucket. So, if you want to, share your screen, I can give you the ability. So feel free. Um,
Okay, okay.
but why don't we start
Well,
off, Marc? If you don't mind telling me
yeah.
just a little bit about how you got into the industry, because a lot of our guys are residential brokers moving into commercial. A lot of them are like business loan brokers. They're trying to do real estate. Tell us how you got your start with Rodeo, or even just commercial lending in general, and then we can get into Rodeo's guidelines. We can see about throwing some deals in your bucket. I'd
Yeah,
appreciate it.
well, yeah, quick story. So I'm 56. So I started out on Wall Street working for various investment banks. And the last thing I was doing, I was working for an investment bank selling special purpose acquisition companies, which are like private equity investments to hedge funds. Bear Stearns and Lehman Brothers crisis hit, and no one was investing in private equity. So my job pretty quickly evaporated. I had to stay on the desk for 2 years to unwind the book. And once the book was unwounded, my job was gone. And people on Wall Street weren't really hiring back in 2009. Uh, so I was doing a little bit of this, a little bit of that, just looking in, trying to, find the next move. And my roommate introduced me to the owner of Rodeo, uh, and they hired me. And that I learned real estate and real estate lending and bridge loans, just trial and error the first couple of years.
Yep, yep. So you are one of many investment bankers and equity guys on the Wall Street. I mean, so many firms, private money lending firms, came out of that crisis because we get away from Tiller-RESPA rules. It gets a lot easier to lend on the private money side. Honestly, I personally don't think there's a better investment than mortgage notes on private money mortgage notes. I mean, these are great rates, fixed returns. So it makes sense that investment bankers, would get hired by these Rodeo for companies like Rodeo, construction, private money lenders. It's fantastic, brother. So very awesome. I'm glad you're in the fixed markets now. So you don't have to worry about mergers and acquisitions, right?
Exactly, exactly. Losing the job. Uh, so my firm is a bridge lender. We're 1 to 3 years interest only. Uh, and what we like, there's two types of assets that we like. One has a residential component. So it's not like a specific asset, it's a group of assets. So we base or we look at property types that we want to lend on in two different buckets. One bucket is that it has a residential component to it. So we're talking single family, multifamily, residential mixed use, student housing, short-term rental properties, 55 and older senior but non-medical communities. So that bucket we're very active in. We go up to 7.5 million on our loan amounts. We could go as low as 250,000, and we're doing straight purchases, straight refis. We're doing cash out borrower wants to buy additional property. We're doing fix and flips. We're doing ground up construction. And what we also do, which a lot of lenders won't go near, is construction completion. So they might have started the project with their own cash, and halfway through, they're like, what the hell am I doing spending all my money on this? Or they went with another lender and the relationship is souring. So a lot of times on builds, I'd say about 50% of the construction loans uh, that we've done are wrong, meaning they're wrong, meaning the budget's not sufficient to complete the property. They misbudgeted, and the timing they took the loan, the length of loan wasn't long enough to complete the project. So they think they can complete the project quicker than they actually can, and they think they could build it for a certain dollar amount, and 50% of the time they need more money, and another 50% of the time. So we have 10% contingencies built in our budget, and even 50% of the time the contingency doesn't cover it.
Right.
So people are really bad at budgeting what the actual costs and timing of a deal. So we like those types of loans. Most lenders won't go near those loans because you need a special title insurance. Uh, you're dealing with lien releases. You're dealing with contractors and subs. Did they get paid? Did they not get paid so far on the work? So there's a lot of extra lift and effort in the underwriting process. We don't mind that. What we like about a completion type loan is the fact that we're hoping that all the mistakes were made, all the misjudgments are now out of the way, and now it's a clear ramp or a clear lane to completion. They can complete it in a certain time. They now know the exact amount of money needed to complete. So if it values out, we'll pay off the existing construction lender, and we'll also obviously fund the remaining build. So on the residential side, we go up to 7.5 million. We go to 70% LTV. So we also go to 70% ARV after repair value on construction.
Okay.
Uh,
Can I
our
can I
fixing,
dig in? Can I dig into that
yeah,
just really quick?
yeah, come on in.
So yeah, I have a flipper right now. He does a lot of flips every year. I don't know, like 6 flips a year, which is pretty good. That's a lot of movement. It's his family, right? It's a family business. I think they might actually do more than that. He's got three right now. He's been going through a company called Rain City. It's local to Washington State. I think it got acquired or something. Something happened. So all of a sudden, this guy's been using this firm. His draws have normally just been he takes pictures, sends them in, gets approved, gets the disbursement. But now this new firm's taking over. They're kind of changing the process, and to get a draw lately, it's been taking him 2 weeks, just because he's not familiar with the process, and they keep changing it. They're restructuring the fund, which is difficult for him. He wants to migrate out of that. So thankfully, he's not trying to bail this fix and flip loan because he's failing. He simply wants to find a new lender relationship to get away from Rain City. And no flack on Rain City, guys. I'm sure they're a great lender. It's just they're going through growing pains, and that's what happens when you get acquired. You know that, right, Mark? So
Yeah, so sometimes with different lenders, the draw process can be cumbersome, and it could be cumbersome for a couple of reasons. Sometimes these lenders are short on cash and they really don't have the cash to make the draws, so they're stretching the process out
yeah,
because they're trying to accumulate the cash to disperse. Uh, but also a lot of times it's just the way the fund control process is. So I don't want to bore guys. But as quick as possible, a lot of funds use third party fund control agents. So that means the borrower is communicating with the fund control agent, who then communicates with the lender, and then the lender communicates back to
right.
the fund control agent, who communicates with the borrower. So
Yep.
it's a longer process, because the lender and borrower are not communicating directly. Now, my firm uses a third party for inspection to see the draws, to see if the work was done, but the fund control process is in-house. So we have a lady who used to work at Haas, that's a really big giant fund control firm, and she's our fund control agent. So now the borrower is speaking to our firm directly, submitting the draws. We're scheduling with the third party inspection company to do the inspections. And then if the inspections and the draw requests match up, in-house, we're sending the wire to the borrower, his GC and his subs. And what we also do is we pay the GC and the subs directly. We don't just pay the GC and hope he pays the subs. We don't pay the borrower to pay the GC and the subs. And the reason we pay each individual on the job directly is you might have heard these horror stories where the GC gets into a fight with the borrower, takes the latest payment, and just walks off the site, doesn't pay the subs. So now he's taken the money for the subs and he's left, and the subs are still owed their money and they have to get a new GC. So by paying everyone individually, we bypass a shady GC or or depending on one person to pay everyone. We'll pay everyone on the build individually.
Right. Justin, do you have any questions really quick on that draw process? I got to hop out and make sure my kid doesn't bust into my room. So you can keep speaking, but I have to do this really
I,
quick, okay?
I'll keep speaking if
All right.
Justin doesn't have any questions.
All right.
I'm good.
Okay, so are you more interested in the single family fix and flips or commercial or both?
So right now, what I'm trying to place is I've got a bunch of multifamilies actually.
Okay, great. So
I'm trying
we
to
do,
place. So
yeah. So
um,
that's in our
I,
that's in our bucket.
yeah,
So that's in,
I sent one over to you, I think yesterday that you rejected. It was a little odd though. It was in Kentucky, rural. It was kind of, I think you probably kicked it back because of the location.
yes. So I apologize for saying no, but nothing worse than a long drawn out no. So I like to get
But
real. If I start asking a lot of questions, there's an interest,
yeah.
but I don't want to draw something out. So what we're looking for are properties. We're really looking for like Class B and higher multifamily,
Mhm.
and we're really looking for properties in or around MSAs. So we want to be within 30, maybe 40 miles of an MSA. So we're looking for
Okay.
population. Uh, and so that was probably, I'd have to go back and look, but I remember Kentucky. Uh, and I just don't think it fit our bucket due to location. And then there's another aspect to multifamily uh, that can kill a deal right away. So we are looking for, on our multifamily that we lend on, minimum rent amount of 1,000 a month per unit. So if the units are being rented for 600 or 700 a month, in places like Little Rock or Memphis, uh, or Oklahoma City,
Hmm.
uh, that would be a disqualification. So the rents that
Mm.
we're looking for on these properties are 1,000 a month or higher. Now, if it's
Okay.
close, 900, 950, that's not a disqualification.
Right.
But 800 and below would be a disqualification. So we're looking
Okay.
for a certain rent amount, and then we're also looking for location, and we're really looking for Class B or higher. Uh, Now, Class A usually qualifies for longer term debt, so we're really looking at the Class B, B plus, B minus uh, sleeve of
Okay.
multifamily.
Because you'll go up pretty high in number of units, right?
Yeah, we don't have a u so we don't have a yes. There's some lenders that won't go above 20 units.
Hmm.
There's a DSCR program, debt service coverage ratio program, that a lot of firms offer. It's a bank product, and it only goes up to 10 units. So
Yeah.
for a 30-year loan on multifamily, I could get you that loan for your borrowers or clients, but it's got to be 10 units or less, and it's got to be 3 million or less loan amount. Our normal multifamily bridge, 1 to 3 years, will go up to 7.5 million. No unit max. We just have a rent minimum. So
Okay.
as many units that fit a $7.5 million loan, we can do.
Okay. I've got a 19 unit that I'll send over to you.
Great,
I'm
great,
not I'm
great,
not
great.
sure I'm not sure on the rent amount, but I'll take a
Send the
look.
rent roll. So when you send a multifamily over, the most important things to me when I get a multifamily request, if it's already existing, right? It's a purchase, it's a refi, it's cash out to buy another
Hmm.
property. Then I'm curious about the current rent roll, the current P&L. Uh, if it's a purchase, obviously the purchase price. If they already own it, then I'm trying to get a semblance. Any property you send me that the borrower already owns, I'm trying to get a semblance of his cost basis. So how do I do that? Date he purchased the property, purchase price minus the current debt. I know that's, his cost basis, unless he also, did some CapEx. Uh, and then obviously borrower's personal financial statement on any deal that you send over. Now, if it's a construction of a multifamily, so there's no current rent roll or current P&L, but obviously I would need to see the pro formas,
Right.
what the rents
Okay.
and the P&L would look like after completion.
Okay. So I've got some too that I think need rehab. And I think after rehab, they'll probably be over that $1,000 mark.
Right. So
But
rehab, that's
okay.
fine. Right. So if the rents are below, I need the current rent roll, current
Gotcha.
P&L. But if there's a rehab component, I need the rehab budget, a quick written description of what the rehab's actually going to accomplish, and then the pro forma rent roll and the pro forma P&L. And then we structure the loan based on if they already own it, it's a payoff of the first with the rehab money. If it's a purchase rehab, uh, so purchase rehab, we can offer a little more leverage. So on a purchase rehab, so normally if it's a straight purchase already existing, we're 70% of the purchase price.
Hmm.
On a purchase rehab, we could do 75% of the purchase, 100% of the rehab,
Hmm.
and maybe even put in an interest reserve to service the debt
Mm.
through the loan proceeds, as long as that totals 70% or below ARV.
Oh,
So
nice.
if there's rehab, the end number needs to be less than 70%, but we could go up to 75% initial purchase because we're also doing rehab, which will increase the value and lower the ARV.
Okay. Great. Nice.
Fantastic. So, question for you, Mr. Mark. What would you? This is I get this. I ask this question to everybody because I need to get a read on what you really do specialize in. And I get that read by kind of asking people what percentage of fundings are you seeing on straight up commercial versus 1 to 4s? Like, where do most of your fundings take place right now today? Where do you
Most of
see
our
yourself?
fundings are most of our fundings are single family, 1 to 4, multifamily, whether they're used as a flip, long-term rental or short-term rental, it doesn't matter. Most of our loans are single family and multifamily.
Okay.
We also see quite a number of student housing, which we like. And then on the non-residential side, uh, I see quite often a lot of mixed use. I'm sorry, not mixed use. I see quite often medical office properties, industrial warehouse properties, and we'll also look at flagged or boutique hotels and motels. We'll do retail if there's national tenants on long-term leases, industrial warehouses, and self-storage. So on
Got
the
it.
non-residential side, most of our loans are either industrial warehouses or medical office.
Heavy industrial is okay.
Heavy industrials, okay. Again, it's 7.5 million or less. If it's heavy industrial, then we would need obviously phase one. Uh, but most of the industrial we're doing are warehouses.
Okay. Did I hear that you were okay with assisted living in commercial or no?
We do assisted living. The caveat on assisted living is that one of the owners used to be in the assisted living space. So he really knows what to look for. And that's a negative to borrowers because they really know how I adhere to dissect in assisted living. So on assisted living, we have bed minimums. So inside California, it's got to be 50 beds or higher. Outside of California, it's got to be 80 beds or higher. So we're not doing like the single family house where the kids moved out and they converted 6 bedrooms into rooms for
Got it.
seniors. So it's 80 beds outside California, 50 beds inside California. We do not do ground up for assisted living because it takes too long to build and too long to stabilize. And on existing assisted living, it's got to be stabilized. It can't be a turnaround play. 40% occupied, a new guy's going to come in and he thinks within a year he'll get it to 80%. Much harder to do. So if we're not doing turnarounds and we're not doing ground ups, what are we really doing on assisted living? We're doing purchases where they have to close, stabilized properties that have to close quicker than the bank could close it. It could be an expansion. They may be 80 beds, it may be stabilized, and now they're trying to build and put on another 40 beds. We like that type of situation. It could be that it's cash flowing nice and they want to pull cash out to buy another assisted living.
Sure.
So those are like the three main loan types on assisted
Sure.
living: expansion, acquiring with a deadline, or pulling cash out to buy more assisted living.
Got it. So just for everybody on this call, if you haven't been brokering for a while, or if you have, you're going to understand that assisted living, commercial assisted living assets, student housing, these are categories that most private money lenders don't like to touch just due to the nature of the business. It's a business play almost. It's kind of like lending to a hotel operator. Like the person needs to know what they're doing. But most private money lenders shy away from this. So I would say this is a great niche for you, Marc, Rodeo, because, yeah, I mean, we just see so many denials and we see a lot of these opportunities. So they might not be the highest leverage, but at least they can do it. So, consider them. I'd say that's a nice little niche bucket on the commercial side.
Yeah,
Um,
we love student housing.
yeah,
So
no, that's fantastic. Cool. Well, Marc, do you want to share your screen at all? Show us a little bit of your stuff. It's your call.
uh I mean, I guess I can, right?
Yeah, give us a visual, just kind of your site, so people know what to look for. When they see Rodeo, if it's the right Rodeo or not. You never know. And then I'm
Okay,
going to
hold
share
on.
my screen once we're all set up. I'm going to walk everybody through that Excel sheet so they know how to place a loan with you, and then you can kind of help me hone in on that sheet as well.
Okay, well, the easiest thing to do when placing a loan is just email me direct a summary of the deal, and based on the summary, I will tell you uh if it's something that we like. If we don't like it, I'll tell you why we don't like it, and I'll tell you the documents needed or the questions that need to be answered in order to
Yep.
get a quote from us.
Yeah, and you guys, if you don't have a deal summary sheet, we have one in our turnkey lender system. So if you guys have access to the turnkey lender system, we have a basic deal summary. You want to basically get that completely filled out on every deal, throw it in the body of the email. We don't like to send too many attachments to our lenders, so they have to search around for the answers. Try to throw everything straight up into the body of the email so Marc can make a decision quickly. And that all can come from our deal summary sheet that you have in the Excel, in the turnkey lender systems. All right, Marc. So what are we looking at here? What do you want to show us?
This is you guys see this? This
Yes.
is our funding page. So these are loans that we've recently funded. So in San Diego, we did a straight purchase of a multifamily. It was a $2.7 million loan. We also, right next to it, I don't know if you're seeing it with, I'm
Yep.
pointing to it. Okay. It was a small loan. It was a purchase and rehab of I think it was five, maybe six units in Norfolk, Virginia. Uh, and it was small loan, but the guy was experienced. He's done like three or four in Norfolk. Really good borrower. Uh, this in Truckee, California, 408,000. It was a lot purchase. So repeat borrower. He's good. He's actually building a loan. We're doing a loan right now with him. He's building a home on it, but he needed a quick close on the lot. Truckee is the California side of Lake Tahoe, very popular, a lot of building going on. So we just did 55 or 60% of the lot purchase price. We lent him so he could nail down the lot. And now what we're doing is, I want to say a 4.23 million dollar spec home build. And this is like his third or fourth build with us. So
Beautiful.
experienced builder, does really good job.
What do you cover? What do you cover on land when someone comes to you with land and a budget to build? Normally our lenders will cover about 50% of the land acquisition, cover possibly 100% of the build, um, interest reserve. Typically, they're covering interest payments and so on. How do you look at a land deal? Do you need to see that it's pre-developed, so a developer already came through and they're ready for vertical? What's your look on the ground up stuff?
Okay, that's a great question. So we don't do a lot of land. When we do land, it's a buildable single family lot in a desirable location like Truckee, or it's an ocean, maybe not an oceanfront lot, but California has a lot of hills and mountains. Maybe it's an ocean view in Malibu or the Palisades or Newport Beach, where you're not on the ocean, but you're high up and you got a view of the Pacific. So, or the last thing we do, it's got to be major infill land in West Hollywood, Koreatown, Los Angeles, maybe Nashville, Austin, Austin, Texas, major market infill land. When we do a lot that's going to be built upon, I don't want to get knee deep in the weeds, but there's two things that go on, especially in California. So California, a lot of these lot purchases, you're purchasing the lot with acquired plans, meaning the person who owned the lot went through the legwork, filed the plans. It's buildable. It's approved to build a certain house, and they sell the lot and the plans in order to get a higher value on the purchase. So the buyer builder's coming in and he doesn't have to go through the pre-development process, the approval process. It's already approved. So something on that, we can do the purchase and the construction together because it's already approved. However, when it's something like the Truckee deal, he didn't have approvals yet. He just needed the lot acquisition. So we couldn't fund the purchase and the construction together. So we just did 55 or 60% loan to purchase on the lot. And then as soon as he got the approval. So once he got the approvals, what we did was we refied the 408 and then funded more construction. But when we charged fees, we're not charging fees on the 408 because we already charged the fee when he acquired it.
Got it.
So the first 408 of we did what we did on this, we did a $4.23 million construction loan after he got approvals. Well, 408,000 of that 4.23 million, we already funded the purchase. We're just
Right.
refining that debt. So that 408 is not being double dipped. We're not charging points on that. We're charging points on everything above the
That's fair.
refi of the purchase.
Yeah, that's fair. And for everybody, to give you context, that's probably not a deal they normally do. It sounds like, this is a established rapport, established trust in a borrower that's been with them for a while, right? So keep that in
Yeah, but
mind.
we've offered that those terms to first time borrowers of ours if they
Okay.
have experience, and we know that they have experience. We'll offer those terms to them. Split the deal into two, the purchase, and then once everything's approved, then we can go with the build.
I like that.
Most of the time, when someone's coming up with us with a lot build, though, it's coming with the plans approved. So on something like that, what we're doing is we're offering on construction, we could offer the lesser of 70% ARV on the build, even though there's an acquisition to it, or 80% loan the costs, whichever's the lower number.
Got it. Let's talk about this debtor in possession deal really quick, and then we can jump on over to our Excel. On your examples, you have an
Yeah, so
8.5.
this
Yeah,
guy, what happened with this guy was he had to put the property in bankruptcy. And what happened was he had a couple other properties that were tied to this. So one default caused a chain reaction of defaults. So he needed a little more than we normally give. Usually max 7.5, but we're a flexible lender. So if we like a situation, we could offer higher dollars than we normally do. We could offer higher leverage than we normally do. We could offer lower pricing than we normally do. Everything is really deal dependent on the quality of the deal and the quality of the borrower. Even though this is debtor in possession, meaning he's declared bankruptcy on it, the courts have the power over the property. So in order to release the property from bankruptcy, the court has to approve our loan. So it sounds a little like, oh, why would a lender want to get involved in that? But no, it actually gives an extra layer of strength because the court is approving it. And borrower, you want to default on the borrower, you don't want to default on the court approving a loan and then you don't follow through on it.
sure.
You're going to end up losing the property.
So was
So
this
it gives
this
an extra
borrower
layer of
was
security to
mhm.
us. So what happened was what he offered up, which is the reason we went higher, he offered up a couple more of his properties. He was probably gave us 16 to 18 million in collateral because he really wanted to save this property. So we were in a great position. And that's the reason why we did it. One, the property was a nice property, income's great, but he offered so much collateral in an effort to get us to do the loan that obviously he wasn't going to default on us. It was a no-brainer. We were, I think, around 50, maybe 55, but we were in the 50s when it came to loan to value
Yeah,
to
that's
help him
not
out,
bad.
get it out of the
They weren't,
property.
am I hearing that the borrower's BK was not discharged or dismissed yet?
No, it gets dismissed with the loan. It gets taken
Wow.
out of and that's
Yep.
why the courts are in charge of it,
Yep.
because it's still in the bankruptcy process.
Yep.
So the courts have to get it out of the BK, the courts have to approve the loan.
That's amazing. Yeah, you're one of the few that would be willing to enter into something like that. So that's another niche little aspect. If someone's mid BK, normally lenders are like, stay away, right? Because you can't collect. But you're right. Banks make deals. Or excuse me, the judges make deals with the borrower to figure out the situation. And sounds like you're savior lender in this case.
Yes. What we're really when you come to us, we're really looking for quality deals and quality borrowers. And then you think that a debtor in possession situation isn't a quality borrower. A lot of times they're in trouble financially, but this wasn't the case. This was uh, you
Strategic.
know, a bunch of properties were tied together that caused like a domino effect uh, all at once. And the guy couldn't pay off caused an accelerated payoff because of one property. and he couldn't do the accelerated payoff. So he
Sure.
had to strategically put it in bankruptcy to hold off the foreclosure process.
Will you do a
So
so this guy was in a portfolio loan. It sounded like there was no partial release. So you'll do portfolio loans in this case? I
we'll
mean,
do
any case.
portfolio loans. He was able to carve this out, but he also gave us extra collateral that wasn't part of the default, just to juice the situation,
Sweet.
get us interested, because he didn't really want to lose the property. It was a really
Right.
nice property.
Right. No, that's good. Medical office, multifamily, that's
You
good.
see, another multifamily medical office, the Truckee. These are single family, spec home. This is a much bigger loan, 12.375, another single family. This is out, Montecito is basically Santa Barbara for those that are not
Yep.
California, that know the cities in California. Montecito is just an awesome neighborhood.
Yep. Another thing to
Another home.
take note of, guys, most of the fix and flip lenders, they like to stay, I don't know, 100,000 to 2 million, maybe 3 million, maybe 5. These are large balance fix and flip deals that most lenders shy away from as well. So when you see large balance, you should be thinking Rodeo. Again, it's going to be more conservative from what I'm telling on the LTVs, but that's okay. If someone's doing a high leverage property, they should have some extra skin in the game.
Yeah, so I'm glad you brought that up. So yeah, there's a lot of like on the smaller flips, you got lenders offering
90.
90% of the purchase, 100% of the rehab. That's not us. So, and you wouldn't go to us if that's the leverage you're looking for. So on flips, 2 million or less, or 3 million or less, we can offer 85% of the purchase, 100% of the rehab. But the borrower would have to come in with 15%. They'd have to come in with the fees, the closing costs. They'd have to demonstrate that they could actually service the debt. When it comes to these bigger deals, what we're doing above 3 million, we do 75% of the purchase, 100% of the rehab. So they have to come in with 20%, 25% of the purchase plus the fees and closing costs. But if it fits the ARV, we're also building in on the bigger loans an interest reserve. Uh, so they don't have to service the debt during the life of the loan.
Yep, which can be
So on
quite expensive on the larger loans having to serve that debt. So it's nice you get an interest reserve there.
so at the end of the day, right, and usually we're charging 10%. So at the end of the day, the bigger loans, we're it's math. So obviously it's not the same. So if we're doing 75% of the purchase, 100 rehab, and 10% interest reserve, tack that 10% on to the 75%. It's almost like we're doing 85, 100. Almost. It's
Yeah,
not, because you have to bring in more up front. You have to bring in 25%, and 25% of a deal over 3 million is a big amount. But how we make it up to the borrower is that during the life of the loan, they're bringing more money up front, but during the life of the loan, they don't have to service the debt. It's
right.
already built into the loan amount.
Totally.
So, so that's the trade-off. You have to bring more money up front, but on the back end, you're not making payments.
Right, right. Okay, so I'm going to go ahead and jump into our Excel sheet, make sure we have everything accurate as possible so people know how to screen these deals for Rodeo. This is the purpose of this Excel sheet. So let's jump into there really quick and then we'll call it a day if that's okay.
Fantastic.
Awesome. All right, so can you guys see my screen? Can you guys see my screen? Are we good?
Yep.
Yeah.
Yep. Okay, fantastic. So if you guys are enrolled in our community and have entered into the turnkey systems, you're going to get access to this lender buckets Excel. So as you can see, we have several buckets. We run our brokerage on a bucket system. Justin, you're familiar with this. Anybody who's in our program is familiar with this. So when you get a deal, you got to know, what bucket am I in first? Am I in a ground up bucket? Am I in a commercial bridge bucket? Is this more of a specialty mezzanine a deal? Like, what are we working with here? So you have access to this bucket list, and each one of these bucket lists has several lenders that might fit that deal, whether it's SBA, gas station deal, or a ground up deal, for example, here. So today, you're going to see Rodeo. We have them in our specialty ground up construction bucket. And when our brokers need to place a loan, the first thing they do is go to this lender bucket Excel sheet. So this is the first thing they see, Mark, if they're going to give you a call. They're like, hey, I need to call Mark on this deal, right? So we need to make sure they know what they should be sending you on every one of these deals. So the first thing you guys are going to see, obviously, Mark, this is your contact information. Has anything changed here with your contact information? I got to ask, sometimes the cell phone changed. You tell me.
I want you to add, so the 310 number is a Skype number, and Skype is going out of service in May. Now I think it's going to Microsoft Teams, so I don't know if it's not going to work or still work, but why don't you add a second number there, in case that number doesn't work.
Sure.
And that number would be 424-527-2944.
Is that your cell?
That's my California cell. And if you want to text me on that number, because Skype I can't text on. So if you want to just ask me a quick question by text, use the 424. Try the
Perfect.
310 first, but if come May, if you're having issues dialing that number, then just use the 424.
Gotcha. So this is exactly why we do these calls. We do one of these calls every single week, guys, and we make sure that everything's up to date. So one of the things about lender search tools and things like that, information doesn't get updated every single day on typical lender search tools. So that's why we built the community, guys. Make sure everything is up to date with our lenders. You're going to see this Q&A section. We're going to go ahead and throw the replay link right here, and only our members get access to that. So when you get into the Excel sheet, you can always jump in and just see the last training. So that's going to go right here. So let's look at why to send you a deal really quick, Mark. We'll update this every once in a while if we hear something new. Right now, when someone goes to this sheet, they're like, okay, why am I sending a deal? You have right here your direct balance sheet lender. You go up to 10 million. Obviously, we've seen a little bit more in your examples. Specialty ground up, construction to completion, high end fix and flip. I'm going to say high value. Fix and flips, cash out, and I just threw in cross collateralization. I'm also going to throw in that assisted living thing. I think that's a big deal. And I have it down below too. And student housing, honestly, that's a really big deal. Anything you think we should add to that?
No, that's fine. What I'm gonna do, you have multifamily there, single family, multifamily. I'm gonna send you, so I don't know if you want to attach it to that sheet, just our focus list.
Sure. If you have
With
like
a
a link,
focus email.
yeah, if you have a link to that of some sort, I can always throw that in there so
Well,
someone can
it's a
open up.
canned email. It's a canned email, so I'll just send it to you. You
That's
can
fine.
send it to the group.
Yep.
And again, it will go over locations, property types, bridge
Yep.
loan types, leverage and pricing.
Got it. After this call, we send an email out to everybody who's in our community. Everybody will get that email out. So you just send it to me. I'll attach it to the email. So they'll get the recording, they'll get this Excel sheet breakdown, and they'll get your parameters so they know.
Fantastic. After this call, I'll send you the email.
Perfect. Sounds good. We like to know biggest hangups. Okay. Every lender has a biggest hangup. And normally this biggest hangup section, Mark, will come from me or my brokers who are placing loans with you. We need to know what the hangups are. So if you want to give us in your honest opinion, like for Velocity, for example, I'm a rep at Velocity. One of our biggest hangups is our appraisal screening process. After the appraisal comes in, we might knock value here or there. That's just how we roll. We're a very conservative lender on the asset value, but we're very relaxed on the borrower. So tell me, what would you say might be your biggest hang up with some of your borrower or your loans that you're putting through? I know it's hard to say.
I think that, yeah, so the biggest hangups are, I would say, are brokers that don't answer the questions. They say see attachments, and then they send 30 attachments. So when I ask a question, I want it answered specifically, but two, I'm not really asking you to do any extra work. If you don't know the answer, I'm not asking you to go through the file. I'm asking you to forward the question to the borrower. These are
Sure.
questions really for the borrower. So a lot of times, and I may be nitpicking, but a lot of times when I ask a question, I get the broker saying, "Well, I think the answer is this," or "I think he means this." Uh, I'm not asking for opinions. I want to know the
Right.
real answer. So they're not really questions for the broker per se. They're the questions. If the broker doesn't know, they're really meant for the borrower to
Got you.
answer.
So what Mark's asking for is a clean submission, and concise answers that are truthful. So part of brokering these loans, you need to be transparent. You can't be afraid to ask the borrower, the right, the actual questions. My biggest pet peeve as a lender is when I ask for, hey, what's the net operating income, and the broker just sends me the appraisal and he says it's in there. So what's gonna happen with this? Am I going to answer that email right away? Or am I going to go to easier emails, things that I can actually answer till I have time to actually open that appraisal up, go search for the NOI, factor out adjustments. It's kind of crazy, right? So if someone asks you a question, guys, just answer it. Don't make us look for the answer. That's crazy. 30 attachments. I'm totally with you. So know your borrower, know your deal, and just do some of that front end legwork for us. We're not asking you to do all the legwork, but if I have a question, just answer it for me. We'll get the deal done quicker. You'll get better responses, and we'll get through with the deal. That's fine.
You don't know the answer, just send the question to the borrower to answer.
Ayo,
You don't,
perfectly
I'm not
fine.
asking you to rip through documents. So,
Well, I definitely, I don't want to rip through documents. I'll tell you that much. When I'm seeing, we're seeing hundreds of deals, every week, right? So we can't be searching through documents for every single answer. If you can help us out, that'd be great. That's how you have to do it. Okay, let's go to loan. Let's just make sure everything's in line here then. So loan amounts were at 500,000 to about 10 million. Sounds like your exception is okay above that. 12 to 18 to 24 months. You're still good there, right?
yep,
2%
12 to
origination.
12 to 36 months.
Okay, we'll get you 36. Typical deals, 2% origination to the lender.
Yep,
Great. No way.
typical, but again, but everything's deal dependent. So normally our pricing is between 9.5 to 10.5,
Mm-hmm.
with 2% origination, but we've offered 9 and 1,
Right, right.
9.5, 1.5. Everything's deal dependent. So
Yep,
just remember that the better the deal, we could be flexible on
absolutely.
rate and points.
Yep. Larger loans sometimes demand fewer points just because we're going to get paid out more, right? So
Yeah.
that's pretty typical. They're not table funding, they're not white labeling, you're not doing YSP. These are short-term loans. We have your categories correct. You're doing 1 to 4s, multifamily, mixed use. We talked about that. Case by case here we have for office, retail, warehouse. Is that true? Case by case and no ground up here, right? Or can we just mark this a big yes?
Well, industrial warehouses, it's case by case because we only lend on concrete tilt up. So if it's a metal sided building, it's an automatic disqualification. If
Got it.
it's ground up, it needs to have pre-leases. It's a build. So on non-residential properties, it's got to be a build to suit,
Okay.
meaning the tenant's in place. We'll do medical office ground up. Maybe it's a 5 unit building and they have three pre-leases. So that's something we would do. Uh, but we're not doing a field of dreams. Build a
Understood.
commercial property and then hope the tenants will come.
All right.
So
If
it's
you
got to
guys
be,
Yep. If you guys don't know the Field of Dreams reference, if you build it, they will come. That's the idea with Field of Dreams. So go ahead and watch that Kevin Costner classic. Okay. Moving down the list, guys. Hospitality, we said yes. Special use, I marked off. We call special use anything that's a special use building, like marina, standalone restaurants, churches, banquet halls. You're not
no
messing with
special
it.
use.
Gotcha. I did see something in there in your examples here on the land heavy. Did I see a golf course in there, or was I incorrect?
Incorrect. No golf
Incorrect.
course.
Okay.
You might have said that you might have read that the house was on a golf course, but we don't lend on golf courses. It's a terrible business model. If the loan fails, it's because the golf course failed. And
Right.
that means we're taking back a failing asset. And then the upkeep on a golf course is outrageous. And it's
Yep.
not like you could like sell it to someone who's going to turn it into multifamily tomorrow. They have to
Yeah,
go through rezoning. And so, yeah, no golf courses.
absolutely. Environmentally hazard. You're still not messing with gas stations, car washes, dry cleaners. Obviously, they are a lender here. So, I mean, sometimes I get this question from brokers. That's why we have it. But pretty much every lender does purchase or refinance. That's why we're in the game, if you guys don't know. They're not messing with equity. So, if a borrower wants equity, this is correct. You don't do equity deals, you don't do mezzanine deals.
We don't do mezz. We don't do JV. We want borrowers that have their share of the cash to complete the
How about
transaction.
recourse? Sometimes, do you do no recourse sometimes, or is it all recourse?
Construction, we want recourse because of the difficulties of construction. If it's an already existing property, we could do bad boy carve outs. And bad boy carve outs is non-recourse unless the borrower commits fraud on the loan, and then it jumps to recourse.
Got it.
So
Bad
we'll,
boy loans. I like it.
yeah, bad
They
boy
have
carve
to
outs.
they have to have an entity to fund with you. Some guys don't do entities. They like to do
Has
purchase.
to be a single purpose LLC, no other asset in that LLC.
Got it. Got it.
So, and forming an LLC is, really 48 to 72 hours. It's not cost prohibitive. But the assets got to be boxed into an LLC. So anything the borrower does outside of this property cannot come back and haunt us.
That's right. And I have a referral for you guys. If you need someone just to throw entities together, it's called Corporate Capital. I met them at a conference the other day. Fantastic business model. They'll throw the entity together, trust doc, whatever it is. So look up Corporate Capital, guys. I think I talked to Flo Turnez over there. He's a pretty good guy. Speed to close. We have 2 weeks after appraisal results. Is that right?
Yeah. So usually a week to 10 days after the appraisal comes back, if the file is completed, we're at the signing table. So yeah, 10 days to 2 weeks after appraisal.
Gotcha.
Yeah.
Now, right here on LTV to purchase, I did hear that you're going up a little bit higher than 70 on certain cases. Is that right?
That's on a fix and flip cases. If there's rehab attached. So if it's a straight purchase, it's 70% loan to purchase, loan to value. If it's a purchase rehab, it's 75% purchase, 100% rehab.
Gotcha. Good to get clarity here to make sure everybody knows how to throw it in. Everything else, look here, your loan to cost, 70, 80% loan to cost. We want to see some sort of experience. Obviously, that's for everybody on the borrower summary, one of like strategy. You're not looking at FICOs. Good to hear.
No, we are looking at FICO. So
All right, well, let's fix that up then.
yeah, 640 or higher.
Okay, see, that may have changed since the last time we talked. It's been a while, so I appreciate that. Doesn't matter on credit utilization necessarily, as long as they're meeting the score.
Yeah,
Okay,
640 or higher. That's what we're looking for. Anything under 640, we would need a letter of explanation. High credit limits are not a problem if they're selling the property, right? It's a fix or flip
Yep.
because it doesn't matter what your credit score is. But if they're saying they got a 560 and the exits are refinance, well, that's not going to happen. So
Right. Okay. Mark, I appreciate your time today. We're going to go ahead and throw this sheet out to everybody on the call today. And if you're in the community as well, we're going to send the recording out. Mark's going to send us his tier sheet so you know what to send. And these
Yep.
updates will go ahead. If you want to see the last lender Q&A, there's always this tab right here. You go to the last one. Otherwise, I'm going to throw him over here in the ground up construction bucket with all these updated terms. So everybody, I appreciate you being on this call today. Mark, do you have any parting words for us?
No, but I mean, listen, we're a boutique niche lender. We're really looking for quality properties and quality borrowers, and we're a make sense lender. If the deal makes sense, it's something we would do. And the better the deal, the more flexible we are in leverage, pricing, and all that jazz.
Good deals, good deals. Common sense underwriting, that's the mantra in private money. So you got a good borrower, you got a good deal. We want to send them some money and earn some interest for our investors. So
Exactly.
Fantastic, Mark. I appreciate it. Everybody,
Thank
thank
you
you so
for
much.
the invite.
Oh yeah, no problem.
Thanks, Mark.
Anytime. We should, Charlotte should be reaching out for you, to you for the next Q&A call, maybe in a few months. All right,
Fantastic.
brother.
Love
God
it.
bless you, Mark. God bless everybody on this call.
Have
Talk
a
to you
good
guys
one,
next time.
guys.
Thank you.
Bye.